Job data indicate that North American economies are cooling, and our guess says the Canadian numbers are pointing toward a recession as the impact of tariffs is felt. He has identified sectors and stocks, some that could be exposed and some that could stand to do well in the current economic environment. We're joined by Gordon Reid, President and CEO of Goodreid Investment Counsel. Great to see you.
Nice to see you, Andy.
You get a feeling the Canadian and US economies are slowly losing momentum?
Some of the air is coming out of what was a very good economy, and they're weakening. I'm reluctant to say they're weak, but they're weakening, and we have to recognize that. Comparatively, the Canadian economy is weaker than the U.S. economy. And at Goodreid, we're positioned for that with good quality companies in our portfolio that we think that will withstand any bumps.
Meanwhile, we have this disruptive period for technology companies. Not sure, should we be hiring workers? Should we be firing them?
Yeah, and I think we have to look at some of the labor statistics with an understanding that we're in a disruptive period and try to understand whether weakening labor markets aren't really a sign of good times, because productivity is increasing. Companies are doing more with less. And again, stock selection becomes so important in that environment. We believe that the Fed will ease in September. That's almost 100% guaranteed. I think we're moving towards a greater likelihood than not that they're going to ease by 50 basis points with the numbers out of the labor statistics this morning. Nothing's guaranteed, but without question, an easing environment is upon us. And it's unusual, Andy. Only 8 times in the last 30 years have we eased, in other words, dropped rates when markets have been at or near all-time highs. So 8 times in 30 years that's happened. Every single time it's happened, a year later, the market has been higher.
Oh.
And it's been higher on average 16%. So the statistics show us that it's good times for the equity markets.
That's interesting. Yeah, I mean, you can see why a Fed would be reluctant generally, with stocks blasting to all-time highs, to cut borrowing costs.
Well, yeah, and I think it's about understanding the relationship between the labor market, which is more representative of the economy, and inflationary pressures. The 2% target that the Fed and the Bank of Canada have identified is really an artificial level. It's quote unquote low inflation, or sustainable or acceptable inflation. And I've been saying here on BNN for a couple of years that I thought that 3 would become the next 2. So or the new 2, that we would actually come to accept 3%. As a number of rise of inflation annually that we could live with. And I think we're pretty much there.
Because inflation is still is now in America, headline inflation close to 3% or a little more.
Yeah. And the lower you go, if you look at where where the components of inflation are, it gets a little stickier, and it's more on the service side. I saw this morning that the numbers that came out highlighted food up 0.5%, which is tough for consumers. And we're going to have to just understand that this is the world we live in now.
Yeah, I'm still shocked at prices when I go shopping for things, especially restaurant meals. Can't believe it.
Yeah, they are very high, and it's the new normal. We have to just get used to it.
I was in a local eatery, and I asked the lady behind the till, "Do you get the tips?" And she said no. So I think from now on, I'll bring a $5 bill with me and slip it into her hand. Yeah. Sectors that are likely to be winners include financials, Gordon.
Yeah, well, when you think about financials, they're really the glue that connects the entire economy. If the economy is growing, then loan growth is higher and financials do better. But under the surface, what we're looking at is, with lower short-term rates and still some nagging inflation out there, long rates are likely to stay a little higher, which steepens the yield curve, which is very favorable for the banks because they borrow short and lend long. So the spreads are wider, and that's very, very good for the banks. we're also seeing a ton of CapEx out there. So there's a lot of business confidence. In fact, small business confidence has turned up since April. And
in America?
Yes.
Okay,
yes.
yeah.
And it's quite strong.
Right.
So the CapEx cycle is intact, which means that people are spending money. And when people spend money, banks do well. The M&A cycle is another sign of good times. And we think that the banks are right on the cusp of doing a lot of M&A business. Very, very profitable for the banks. So at Goodreid, we are overweight banks.
And plus IPOs in crypto and AI,
Yes.
that's a nice money maker as well.
That's true.
Sectors that could be vulnerable, consumer staples and discretionary?
Yeah, the consumer is vulnerable in this environment. We just talked about it with restaurant prices and food prices. We're seeing the lower demographics really pulling back. And I think a lot of the consumer numbers, the confidence numbers are really at the higher end of the demographics. So it's they're being held up by the more wealthy component of our society, and we're very conscious of that and picky when we're choosing stocks.
It's interesting, actually. I'm just looking at Loblaw, L, or Metro, MRU, both off their highs. They would be classic consumer staples plays.
Well, they are, and you know, they're companies. The grocery business is notorious for very thin margins, so they operate on pricing power, but they need the volume as well. So they're tough businesses to operate in any environment, and this is a disruptive environment, as we discussed, and makes it more difficult for these groups.
Gordon, thanks very much indeed.
Thank you, Andy.